Welcome to the Private Equity Exchange 2007, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. The Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet, enabling them to move quickly from ideas to deal crafting. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs.
Thank you for being here. I wouldn't say despite the strikes, because there's no more strikes. Thanks to a very strong and a government with leadership. And a government with leadership attracts the leaders. And we're very proud to have here together with us Mr. Jacques Attali, who has been for 14 years advisor to François Mitterrand, and who is now, as everyone knows, advisor to Nicolas Sarkozy. Both men who have a very intense leadership. And having graduated from Harvard Business School, I've met a lot of powerful leaders, and wow, they're strong. Please welcome Jacques Attali.
Thank you very much. I'm not the advisor of the President of France today. I was very proud to be the advisor of former President François Mitterrand, and as an independent personality, I've been asked to chair a commission, an independent commission, to try to define the main breaks for French growth and to define some solutions, but far from being, which would be something quite honorable, I'm not an advisor or president of today. I'm very happy to be with you this morning, even if it's for a short period, because I have to go for a meeting of that commission at 9:30. Just to tell you that it's very important to have such a meeting, to meet people of your qualities, to involve in the private equity business. Private equity, as I said, some of you in another meeting some weeks ago, is absolutely fundamental for the development of economy at a moment where we see a very difficult clouds around us in terms of the evolution of the financing of the economy. We all know that we are beginning to face a crisis which is linked to the way it has been financed, with lack of governance, lack of prudence, lack of organization, and what has begun in the US and is now spreading around the world can be a very, very difficult time for the whole of the economy of the world, and new rules are needed, and you are certainly being part of that to be established. But also, as actors, you are not well known enough. You are very often seen as the ugly guys, the bad boys, the people who try to take out of the companies the main of it, and just for having higher rate of return, without providing really a huge development for the companies, and it is not true. As I said to some of you, you are very good in finance, but very bad in PR. And a lot more is to be done for you to help in the different dimensions of what private equity and financing of companies and restructuring is needed. In this world of evolution, there is a huge need for more private equity, more restructuring, more evolution in new technologies and in companies to be reshaped, mainly in Europe, where the resources for small business, innovations, risk-taking people, entrepreneurs are far from being enough, where the pension funds are not here, where the insurance company are not doing enough, where the fiscal system is not the best, and where you are needed with your engineering to develop these capacities. I do believe that your exchanges on these different fields will be very important. There is no reason for Europe to be lagging behind the rest of the world in terms of rate of growth, in terms of innovation, in terms of development of small business to large companies, and your activities is absolutely crucial to help the entrepreneurs to develop. And I do hope that your exchanges will bring something for that. but I know that you have some questions to ask.
Okay. First, I should say that because of a very busy schedule, the question were not given and handed to him before 1 minute ago. The first question is on microcredit. Is it only half the way? I hope I can claim paternity on the idea of micro capital, because microcredit is just credit. It's finance, you have to give it back. So do you think that micro equity should be assisting micro debt?
As you have not mentioned, but maybe some of you know, I'm chairing a company or a non-profit, which is called Planet Finance, which is the largest in the world today to support the development of microfinance in the world. And we have a conference this afternoon of the World Microfinance Community in Luxembourg, where I'm heading later today. Microfinance, as you say, is mainly microcredit. It is already reaching 10,000 microfinance institutions with more than 150 million beneficiaries. Microequity is just beginning. You understand that it is very difficult because you don't have an exit. And the exit for a credit is paying back. The exit for microequity is suppose either an LBO or people to buy back or any secondary market to do it. There is no microequity institution except in France for the French companies, and Planet Finance has created the first one. We have a fund. It's why I'm part of your community, both as an investment banker in my private life and in Planet Finance. We have a fund called Financité, which is providing small amount of equities between 50,000 to 200,000 euros to the small entrepreneurs, and we will experiment that. But the future of it will be linked to the possibility of creating larger secondary markets, or even a larger kind of Alternext for the very, very small companies. And this is something that we are looking at. We are also planning to open micro-equity vehicles in the Caribbean, and we are discussing to do it also in Argentina, Mexico, Indonesia, and India, which are going to be the next ventures.
So imagine that all those big jumbo or mid-size LBO funds start doing micro equity, not backed by just sweat equity, but also reputation equity by entrepreneurs.
We will be delighted to have them partner in our funds.
You got an offer. Raise your hand. Who's interested? Just interested.
No, we'll see that later.
Okay. Second, macro equity. Macro with the MA this time. If today's private equity revolution is a paradigm change because of the size, $20 billion funds, because of the size of the deals, $45 billion deal, TXU, for example, because of the shape and also the talent. Recently Al Gore joined a VC fund, Kleiner Perkins. Jack Welch is working for Clayton Dubilier. Your brother is working for TPG. So if this private equity revolution is pushing the public equity central role to another place, less central, or a dual core, a central role for public equity, a central role for private equity markets, what's your view on this paradigm change?
Well, you forget a very important actor, which are the sovereign funds, which are going to be a very important actor in the future and will certainly change the rules. I do think that is important, and that the question of the exit is absolutely crucial for the equilibrium between these three markets, and the question of the governance. The danger from going from the public to private and from private to sovereign is a risk of lack of transparency. And the lack of transparency is leading to a lot of mistakes, as we have seen in the subprime crisis. And then, therefore, I would not advise anyone to go more into that direction without putting in place a real, clear, and universal governance bodies.
So I guess, if I'm correct, sovereign funds are in the private sector, in the private realm. Yeah. So they're just a sub-segment, a bigger sub-segment.
They are not that. They are also having rules and goals and aims which are linked to the fact that they are linked to pension schemes or strategic global national strategies. Of course, the Norwegian sovereign fund is very different from the Kuwait or the Russian one, but they have certainly some national goals.
And we have CDC.
It's not sovereign fund.
Okay. Last question, and feel free to elaborate on other topics if you still have. We still have 10 minutes, and maybe we'll have questions from the room. Restructuring France, both in terms of the legal, tax, and cultural framework. You've been instrumental, and I would like, on a personal level, to thank you for the hard work you're doing. Probably the décret d'Allard can be a leverage to kill some corporatism, old frameworks, and it's a constitutional right. So restructuring France and restructuring the geopolitics of France. The restructuring France, I'll let you elaborate on what's going on. The geopolitical question is, Charles de Gaulle said, Europe from Atlantic to Ural. What do you think of it?
And you give me 2 minutes for that?
No, you have 10 minutes. You have 10 minutes remaining. Okay. Nicolas can wait. That's the plan.
I have to leave you in 6 or 7 minutes. I see many questions in your question. First, the restructuring of France today is what I'm trying to do in my commission with a lot of outstanding talents, member of this commission, and we see that there are enormous trumps for France. France is a potential winner of the future if it's able to change the organization of states, to increase its efficiency, to reduce the total cost of public services, to increase the use of e-government as well as the development of new technologies in the economy, to increase the mobility of the actors, to develop excellence and competition in a lot of different sectors. And we are going to provide advice, and no more than advice, as a commission for that. But what we have seen in the course of this trip in France for the last 4 months, that there are enormous talents, enormous potential, and that there are some difficulties which are mainly linked with the fact that it's very difficult to go bottom up, to go from a suburb to become a millionaire, or to go from small schools to come into the great school is very difficult. Just to give you one figure, less than 10% of the students of the French equivalent of MIT this year will be coming either from the suburbs or from the working class. Less than 10%. It's a disaster. And I can name the fact that there are other reasons to believe that there is a huge loss of talents and opportunities in France, and therefore mobility is a key for the future. The development of new instruments of financing is part of it, but this is also linked to the question of pension funds and the use of financing coming from the insurance company, and we are working into that. France is also, as you said, a wonderful future, has a wonderful future. I do not discard the fact that France can become a very important financial center worldwide. This is a matter of an airport. This is a matter of some tax regulations and capacity to organize the different financial sector, but we are going to provide advice and put as one of the main ambitions for France in the next 10 years to become #1 in continental Europe in terms of financial sector, and will provide a lot of recipes for that. It's far from being impossible. In terms of, we have also other talents of France, as you know. One is the fact that health system is considered as the best in the world. The fact that tourism, we are considered as one of the best in the world, and we can do better. That in terms of welcoming foreign investment, we are among the best, and we can do also better. And therefore, France has a huge potential, and we will build into that. Core is the relations between innovation, social mobility, and research, and small business, and the financing of small business. This is the key missing links that we are facing. We also have, as you mentioned, the relations with our neighbors. I was proud to be the founder of the European Bank for Reconstruction and Development 15 years ago, and to have seen that the future of Europe is East more than West. And it is still a frontier. Russia is still to be rebuilt, and this is a huge market for us, and Eastern Europe as a whole is still a huge market, although unfortunately it was more a market for the American companies than for the European ones, but it's you cannot organize a D-Day if you don't have companies ready to do that. We also have another future that you mentioned, which is Mediterranean. If we are not able to organize Mediterranean Sea and neighbors as partners, this will, as friends, they will become enemy. And therefore, it's true that the next challenge will be Morocco, Algeria, Tunisia, and the rest of the Mediterranean Sea. It's very difficult, as we have seen 2 days ago with the fact that a long-lasting privatization in Algeria has been delayed, which is an example of a very difficult thing that has to be done. But the future of France will certainly link to the capacity of organizing a common market to begin between the Mediterranean countries. This is a huge endeavor, and we certainly have to be partners into that. Last question.
Since we have I'll just stay on this one. Since we have a couple extra minutes, can you tell us more about the pace of change you want the government wants with you to bring to France in terms of leveraging growth and making growth happen?
This will be my concluding remarks. We are going to give our report to the French president first week of January. And then it will be up to the government and the president to know what to do with it. The president was kind enough to say publicly that whatever we are going to propose, he will implement, but we cannot ask a government to implement whatever a commission is proposing. But we will be following the potential implementation of our proposals during the whole of the next year, and my contacts with the president as well as with the government demonstrate that they are really in line what we are going to propose, and that a large part of what we are going to advise to be done will be in the process of being done in the first months of the year, on the competition sector, on the reform of the financial sector, on reform of state, as well as development of new sectors such as housing, biotech, and a lot of other dimensions. We have listed more than 200 proposals, and we will focus on less than 20, but this is a huge work to be done, and we are proud to be part of it. Thank you very much.
Thank you very much. Thank you. Please give a big round of applause. They have a lot of work. We're now going to have two very important characters joining on stage. Sébastien Bazin from Colony Capital, despite the rumors that he would be doing anything else, and from Coliseo, and Mr. Russell Sterlish from Starwood. So obviously some of you can be still thinking, why real estate guys? I mean, this is the LBO conference, right? Well, not right, because we're the private equity exchange, and private equity includes private equity real estate. And obviously Starwood was the Tétinger deal, and Sébastien Bazin with such deal as Accor, or as Carrefour has demonstrated, not to mention PSG, great deal, has demonstrated the ability to see beyond the obvious. So I thought they were inspiring speakers and inspiring person to challenge conventional wisdom. Sébastien, do you want to start?
Yes. Bonjour. Just one quick minute on, because we're being asked to basically have a minute on who is Colony, who is Starwood, and then try to give you some takeaways, which is difficult when I'm actually in front of you. Minute on Colony, I'm not going to bore you. Colony is large enough, it's $35 billion worth of assets of investment. It is like 10 billion of equity. It's been achieving a 24% return to the investors since 1991. Europe represents today a third of the activity, roughly 10 billion of investment. Europe has a better track record than the US. It's not, I guess, we are better, it's just, I guess, we operated in a better cycle, because Europe is achieving over 30% return. But one thing which is worth noticing, which I did not really expect at the time I started 10 years ago creating a colony in Europe, is the multiple on equity are basically above 3 times equity multiple for Europe, which is obviously much better than anticipated. It's basically operating on the 3 continents. We have 5 offices in America, we have 5 offices in Europe. Paris is actually the headquarter for Europe, and we have 5 offices in Asia. And we actually opened an office in Beirut a couple of years ago, and we're opening 1 office in Abu Dhabi and 1 office in Dubai. So that's Colony at large. I usually say that Colony is the smallest of the biggest, or the biggest of the smallest. It's still a partnership. It's owned by 10 partners. One is much bigger than the others, Tom Berrick. He founded Colony, and actually, what Pierre-Etienne said this morning, because there was some rumors on the radio that I guess I was leaving Colony at the end of December. Actually, I was not leaving. I was fired from Colony at the end of December because Paris Saint-Germain lost again on Sunday. It's a true story. A true story is, I guess, Paris Saint-Germain lost. It's not a true story, I guess I'm leaving Colony.
He's staying.
But it tells you basically how very small, what is 1% of the investment being Paris Saint-Germain really puts a lot of emphasis on Colony. But it's my mistake. I knew what I was doing, and give me 5 years and we will succeed. But I need 5 years.
And Morgan Stanley.
Which is actually a pretty good transition to just the 2 or 3 minutes on takeaways for us. I have to say, and maybe you disagree with me, that today's environment is far better than the one we operated in basically last May or last June, as far as I'm concerned. As you know, Colony was created and was labeled as a vulture fund. At the time it started in 1991, and vulture basically meant that I guess we made money on somebody else's misery. And guess what? For us, we are contrarian. We love confusion. Confusion creates opportunities. When we're looking at a lot of deals last May, we just simply could not compete. Our cost of capital was too aggressive. So as far as we're concerned, yes, we're going to get into this huge credit crunch, and you know what it is. I'm actually a great believer that those who've been in business, which is basically all of you here and me, for more than whether it's 5, 10, or 15 years, who has basically passed cycles, and who are going to be remaining disciplined, will succeed. For me, the 2 key words that I guess I've been giving everybody who's in Colony is you need experience, but experience goes with age. And I think we're a bit better today than basically when we started 10 years ago for me. But you need to be enormously disciplined, which basically tells you that in today's environment, probably the best discipline is to just do nothing, at least for the next 4 months. And the reason why I said that, and I think you share that, we have no idea what the world's going to be all about in the next 2 months. I think nobody has any idea. We also believe that I guess it's going to get worse before it's going to get better, and when it's going to be that bad, probably means that I guess it's going to be not as bad as people expect. So whether that's going to be in February, in March, in April, I have no idea. The fact that the banks clearly are still today lagging a lot of transparency, and for those of you actually who did not see it, for me what was extraordinarily striking, which was only 2 weeks ago when I was actually in New York, is we've talked about actually the credit crunch, the SVI, structured vehicle, investment vehicle, the conduits and everything. But there was some 2-pagers on the Wall Street Journal about the amount of off-balance sheet debt for Citigroup. And it was exactly at the time where they actually announced this $9 billion write-off on basically asset-backed securities and others. And in this 1 page of the Wall Street Journal, they looked at what is the size of the Citicorp balance sheet, the off-balance sheet, which for me was striking because that size was $320 billion of off-balance sheet liabilities. And more striking out of this page, where they looked at 2005, 2006, and expected for 2007. And guess what? On this $320 billion, at the end of 2005, the so-called asset-backed securities, structured vehicle, were there like for $28 billion. Expected for 2007 is $165 billion. So it went from 27 to 160. So now people understand why it's being extremely difficult for the chairman, the CEO, the chief financial officer to really understand not only what it was, understand how much they have, and understand whether by them having played the intermediaries, how much of that they're going to come back on balance sheet versus off balance sheet, which is also why he's talking today of 25 billion. The reason why I'm saying that, because I was shocked when I was looking at this 160 billion, and none of that has been written off yet, because it's deemed to be off balance sheet. So clearly, for us in the next 2 to 3 months, is we know, and we've been experiencing it today on 2 deals we're trying to consume to do like a 300 million or 500 million bank financing. We today discussing with between 5 or 6 banks, and each of the banks wants to basically get a 50 to 60 million maximum check, and none of them basically would like to do an underwriting. So it is painful. It is a dislocation. It is going to be more costly. We haven't seen today multiples retracting. We know we have lesser debt. We know we have a much more expensive debt. We haven't seen basically the prices going back down. One last comment, because I need to talk about actually what I know is real estate, is at least one thing that people did not notice, at least for the last 4 years. All the real estate fund, which Colony is part of, have been making a lot of money on what we call momentum cycle. So being momentum player, whatever we would have bought for the last 5 years, everybody would have made a 25% return. It was basically because the cycle was helping everybody, and because it was the arbitrage between the cost of financing and the yield on the asset. That positive arbitrage is gone. Today, we're basically working on a negative 50 basis point spread, where we've been enjoying a positive 150 to 200 for the last 4 years. So anybody who's been fetching 25% return in real estate in Europe for the last 5 years probably means that I guess he missed on the road what he was doing, because the market really is probably half of that 25% expected return. Those who probably going to be good players or good investors for the last 4 years has those enjoying at probably a 35 to 40% IRR. They have to do better than the underwriting, because nobody basically could underwrite as a cycle. So it's going to be much more difficult time ahead of us. We're going to have to be more disciplined. We need to get the ethic. And probably for those bankers in the room, we need you more than ever. But I just wish that, I guess, whatever relationship we built up with you for the last 10 years, which was a very good relationship, the last 6 weeks have demonstrated, I guess, that relationship is almost gone within like 5 minutes. People are angry with one another. It's really uncomfortable. So we just hope that, I guess, by year end, all of that's going to be behind us, and we can reconstruct something.
My name is Russell Sternlicht, and I'm a partner at Starwood Capital and responsible for European operations. For those of you who don't know us, like Colony, we were founded in 1991. It's an honor to be following Sebastian, because we believe that Colony has been the gold standard for doing business in France as a private equity firm. We have invested over our history about $5.5 billion of equity in companies that have currently listed market value in excess of $30 billion. And we currently own and manage about $15 billion of real estate worldwide, mixed asset class, residential, office, hotels, and the like. We're a global company, about 140 professionals. Like Colony, we have 5 offices in the US. We have 2 offices in Europe. We have 3 offices in Asia, and we too are looking at expanding our global footprint. As far as Europe, we own approximately $7 billion of assets in Europe, primarily in the hospitality business through the acquisition of Société du Louvre and Groupe Tétanger 2 years ago. We operate through Concord Hotels, Louvre Hotels, Baccarat, Anik Utal, and we own 30 Meridians in partnership with Lehman Brothers throughout Europe, including the asset that this conference is taking place in. Places us in the unusual position of owning this asset, having this managed by Starwood Hotels, and owning and operating the asset across the street, the Concord Lafayette. So we have perfect information on Port Maillot. And we are expanding our European presence in our team, and recently hired Franck Ebrard from Price Waterhouse, who is our transaction services partner and the lead on their transaction services division, to come aboard and to help us with our integration of our European portfolio and to identify new acquisitions for us. Our track record is over the past 16 years, we've generated a 35% IRR net to our LPs. Our LPs tend to be institutional investors from around the world, sovereigns, corporate pension funds, CalPERS, CalSTRS, the teacher and the public employee pension funds of California, et cetera. And we have executed or gained liquidity through a number of measures, including public market executions of Starwood Hotels, iStar Financial, equity residential properties, and created and own American Golf, which is the largest golf course owner in the country, in the world actually, and the Senior Resource Group, which is the largest assisted living company in the United States. As far as our European priorities, we're in the process of raising our 8th series of funds. Traditionally, we have raised opportunity funds, which are exactly what they say. They are not sectoral based, but they pursue opportunities across the globe. 2 years ago, we raised our first hotel fund. We are raising our second hotel fund right now. We are also raising an energy fund where we see interesting opportunities, which are, again, underlying real estate. Notional amount of what we're going to be raising is about $7 billion. To invest worldwide. And to date, roughly 25% of our investments, 25% of our capital has gone into Europe. Going forward, we would expect about 40% of our capital going to Europe. So we'd be looking to deploy somewhere between $2 and $2.5 billion over the next couple of years. Charles and Pierre have asked us to just comment very quickly on our messages to the investor group that is here. And the institutions and the CEOs and private equity firms. Our model is pretty simple. We think macro and we invest micro. Markets, in our opinion, rarely move uniformly, and we need to be sensitive and opportunistic in our approach to all markets. We avoid the herd mentality. We have seen a number of instances where people are investing in Center City, London, with 20% plus IRRs. We think those opportunities exist. But we need to pay particular attention as we move to local markets to the cultural mores and the business habits of the local markets. And sometimes the best way to do that is not through being solo in those markets. Sometimes the best way to do that is through partnerships. And so what we believe that we're doing outside of the UK and outside of France, where we are direct, is that we are sourcing partners and not transactions. When you're a private equity fund of our size trying to get several $billion invested, investing in single assets, 10 million euros, 20 million euros doesn't make sense. And so we would rather form partnerships investing 100 million euros in a partner and in a sector in a specific country than go ahead and invest on an asset-by-asset basis. When you have the cost of money that we have, our opportunity fund and our hotel fund both seek 20% plus returns, you need to consider how you add value to real estate. And we do that in a number of ways. We take a very disciplined approach across asset classes. We tend not to bid down returns, in keeping with Sebastian's comments, to get a deal done. We underwrite, we think correctly, we risk adjust our returns, and we will not, despite the fact that we may have some operating synergies with the company, we will actually not bid down returns and take opportunity fund deals and bid them down to value add levels, 14% levels. We tend not to be horse traders. The average life of an asset in our portfolio has been 4+ years. And we tend to think strategically about how we add value to real estate. We look at complicated deals. We look at asset reformulations. We look at changing or supercharging our business models. As many of you have seen, many of you may have read, we are in the process of changing, hopefully, the culture of Baccarat and really investing in a new business model for Baccarat, changing the business management team, changing the culture of the business, and essentially, hopefully, putting the company on a new growth trajectory for the future. We've built and we continue to build a number of brands. And the role of brands is actually very important to us because what they enable you to do is they enable you to achieve outsized or better risk-adjusted returns on the real estate that you do occupy. So through the creation several years ago at W Hotels, through what will now be the new creation of the Creon brand of hotels or the Baccarat brand of hotels, we believe that we can achieve some great operating results for either our owned real estate or our managed real estate in the case of a third-party owner. And then finally, we define and we challenge and we redefine our investment thesis. We adapt as we go along. And I think it's a very important message for everybody in this room is that how you enter a deal is usually inevitably you will make mistakes. The one thing I can guarantee you about everybody's underwriting in the rooms is that they've always been wrong. And so you need to be flexible in how you adapt. your exit strategies and how you adapt your model as you move along. Thirdly, and our big mantra is that we believe in taking care of the downside. And we do believe that if you take care of the downside, then the upside will take care of itself. So we place a high emphasis on diligence. And it's not only diligencing partners and transactions, but it's actually knowing everything that you possibly can know, down to sometimes a very micro level. With Anik Gupta, we're opening stores in London this year for the first time. And we have focused the company on aggregating electricity data, garbage collection data, anything that they can to minimize the beta on the store pro forma. And we do the same thing, obviously, in the real estate industry as we move along. Secondly, the way we minimize downside is by bringing in-house expertise into our company. We have, over the past couple of years, hired a new development team from IntraWest, which is one of the largest resort community developers. We have brought on an in-house creative team, in-house asset management team. We purchased half of a restaurant company, half of a spa company, all in an effort to, again, minimize the beta of what we do at the hotels and on our development schemes, and to add value to our partners. Because what we believe is that we can transform what have traditionally been cost centers in hotel properties to profit centers in hotel properties by asset managing.
Can I? Sure. We still have 5 minutes for having some insight with two different viewpoints, or maybe they'll be converging, like real estate and private equity. First question is on convergence between private equity and real estate, or the overlapping part of the two circles. What's your silver bullet insight to share with the room?
Well, real estate is a huge asset class, and it's much more liquid than anybody thought. And I think that traditional private equity players look at the returns that Colony and Blackstone and we have achieved in the real estate business with ostensibly less risk than an operating company, and it has become very attractive. The one thing is that this business is different cycles and has a different rhythm than the corporate business. And it really does take the specificity and the years of experience to be able to judge how to get in and out of the asset classes.
That was a gold bullet, not silver. That was a golden bullet.
No, you know, I think it's going to be greater than ever in terms of actually dependency. The one thing that I guess we have all to agree upon is we are real estate specialists, real estate expert. We're not, for this, real estate buyers. And what I want to say by this is you've seen Accor, Carrefour, Buffalo Grill, the kind of transactions we kind of actually entered in. We are a great believer that you have a lot of leverage buyouts who basically buying companies where you have a lot of real estate dependency. They need to control the real estate, they need to operate the real estate, they need to develop the real estate. They probably do not need to be the owners of real estate anymore. And France Telecom started it 9 years ago. Accor actually has done it for the last 4 years. There's a lot of actually real estate who could be untangled, who could be sold, which is a huge help for basically structuring the transactions. Probably more so today than it was in the last 2 years, because people are going to have to be much more financially engineered in terms of actually structure. The one thing we need to do with the LBO partner, they know how to manage people. We don't. We know how to extract value from the real estate. But we need to be hand on hand with the LBO operator with the same alignment of interest from entry to restructuring to exit, which basically means that Colony going to be there to materialize, liquefy the real estate, sell that to sovereign funds, Abu Dhabi and others, GIC. But we are not going to be the buyer of the real estate because we simply do not have the cost of capital. So if they agree on partnering with us, then it's fine.
So to face China, Brazil, competition from emerging companies backed sometimes by their governments, they should sell their real estate assets and focus on growing the business?
I'm not going to give any lessons to the Chinese or anybody.
No, I'm speaking of French companies or European companies. You're saying that because they should focus on managing their companies, they should focus less and cash out from their real estate.
What I'm saying is whenever you have a discrepancy in between the price value of the company at which you can acquire either the company or share the company, if you have a discrepancy between that price and the underlying real estate value that you can untangle, by creating value from the real estate alone, you really have some downside protection and really upside. The problem in doing that is you need to be very careful that by selling the real estate, you're not going to be damaging the operating margin, sustaining the operating margins of the business. The hotel industry found that out almost like 15 years ago with basically Marriott, with Host Marriott, followed by Intercontinental, followed by Accor. Accor's done only floating leases, which was unheard of. Nobody ever understood that, I guess, somebody would go in only floating leases. The retail industry, which is Carrefour, is going to be probably more difficult because the margins are much slimmer. And because they're depending a lot basically on the warehousing. So one thing we have is a lot of education to make sure that whatever we could be doing on the real estate side really will be a plus for the underlying companies as opposed to be a negative.
Just to add to what Sebastian was saying, I mean, you cannot divorce the real estate strategy from the operating strategy. And what you must do is you must consider the competitive dynamic that is put in place when you have a levered or fixed cost operating company alongside of an unlevered company. We looked at Travelodge last year, as many of you may have read in the paper, and our issue with Travelodge was it was a sale-leaseback estate, which we were looking at LBOing. The resulting leverage, the true leverage of the company, was in the 90s as a result, competing against a unlevered company in Whitbread, in Premier Inn. And it's an awkward position to be in. 1 pound of RevPAR in our numbers was 800 basis points. In the return. And though the companies had taken a divergent operating strategy for the previous 5 years, you know, the question that we had to ask as fiduciaries for LP's money was what happened if PTI decided to seize the day and to actually compete on a price basis, and we were not comfortable again with the risk-reward scenario on that asset.
I'll ask only one other question we had planned because of timing issues, and I apologize for that to you. We have in the room, we have CEOs of industrial companies and service companies. We have limited partners from Alpinvest and larger or institution of this size. And we have funds, LBO funds. We don't have any more venture fund except the exception because we're going to build an innovation, entrepreneurship, and venture capital conference. So we spun off this part. To focus now not on the LPs as you did, Russell, or on the industrial companies, but on the LBO fund in the room. How can they work partnerships with you guys to leverage their real estate components?
A bit what I said earlier. The good news about real estate, it's actually a business, and if you don't know anything about real estate, don't touch it. Which is something for hotel, which is the same thing with energy fund. I guess it's basically a lot of specialists and a lot of experience. So we have experience in real estate. We have experience on liquefying it. We have experience on appraising whatever it's worth. We have experience on who should be the correct buyer of that real estate, wherever in the world. And we probably have a better sentiment, which is probably the key today, on where real estate prices will go in the next 12 months. Clearly, up until June, everybody was thinking that everything goes to the moon. Everything. I mean, from multiples, from EBITDA, cash flow, market penetration, everything. Real estate today, the one thing which is key is for the last 40 years, for any big long-term pension fund, it is the best asset class in terms of actual performances over a 40-year term. So we know that I guess for the next 12 to 18 months, when the market is going to be so volatile, and they are indeed extremely volatile, you have a paradox in between. Basically, prices will diminish all over the world. They should diminish because of actually of a lack of liquidity. At the same time, liquidity which exists today, which is basically, we talked about it, the petrodollars, the sovereign funds, which is 2.8 trillion. Abu Dhabi alone has $650 billion of investment capacity, which is more than what we basically collect in 1 year. Fundraising is 400 billion. So those basically long-term pension money are looking for some home where they're going to have lesser volatility, when they're going to have a good asset class in which they can sleep for the next 10 years. The problem with this is probably means that I guess cap yield will not go back up that dramatically. Today we're at 4.5, 4.25, 3.75, 5%, depending where you are, between Warsaw and London. It probably should go up by another 50, but it won't go up by 200 basis points. Why? It's because you had that new money chasing CBD, Class A assets, Class A tenants for the next 12 years. So we just have to structure something for them because they will inevitably put between 8 and 15% of their money into real estate classes.
Thank you very much to both of you for sharing insights with such precision and such concision. I stopped counting the civil and the golden bullets. Thank you to both of you.